Bank of England is almost certain to cut interest rates to the lowest point in more than 18 months. Now, most economists predict that the cost of borrowing will fall by 0.25% today, taking it to 4.5%. Now, it would be the third cut in interest rates from their recent peak in August of 2023. That's what we're expecting today. It comes out at a difficult time because the UK economy is stagnating, but inflation remains pretty stubbornly high, and that is a headache for policymakers right now. Inflation did fall to 2.5% in the year to December, but it is still above the Bank of England's target of 2%. All that, of course, before changes in the Chancellor's budget that are forecast to push up inflation when a rise in things like the minimum wage and in employers' national insurance contributions, they come into force from April. So let's talk now to Dr. Steve Nolan, who's an economist at Liverpool John Moores University. Steve, good to have you here. So pretty baked in, isn't it, that we might get that cut at midday today, sort of half an hour from now. But as always, the devil is in the detail, and we'll get a sense of what they're thinking could happen next, because all of those forecasts about how many cuts and how deep there will be this year are changing by the day.
Yeah, that's true. I think the big story will be what the governor signals, both in the press conference and in the forecasting report. And as you mentioned, yeah, those kind of market rates have been whipsawing so much since November. And basically that is the story of kind of global instability. I mean, it feels like about 3 weeks ago, but it was only on Monday. Over the weekend, we had the kind of brouhaha over tariffs on Canada and Mexico. And there's still a threat hanging over the EU in terms of tariffs. For the UK, the president's making nice noises, but if there are tariffs in the EU, that's going to affect their economies, which is going to affect demand for our exports. So that's going to put downward pressure on growth at the moment anyway. And so that might be what the bank might be signaling going forward, and more rate cuts. But just in general, the task the bank has at the moment is unenviable. We're seeing lots of noise from America and lots of instability in the global kind of economy that should be underpinned by stable institutions. But we're seeing at the moment quite a lot of an instinct for rule breaking in kind of one of the largest players within that, which can only create more instability.
And I touched on it in the introduction, that idea that the UK economy faces this sort of stagflation picture, doesn't it? That inflation's still pretty high and economic growth pretty weak. And critics would say everything they've heard from the Chancellor does not inspire confidence in terms of getting things growing again, because she's actually laid a lot of extra cost on business that she also wants to grow the economy.
Yeah, I mean, that's fundamentally true. The kind of national insurance rise in November, that's coming in April, definitely feels like a downward pressure on business. We saw that today in reports on kind of one of the indexes on production. That's down. There's a lot of signals that growth, which is basically the main objective of this government, is not kind of playing ball.
We will watch and wait and see how